Hey, good morning, everybody. It's Hammer. Today is Thursday, October 30th, 2025. I, of course, am Hammer, the founder of products to help you, my mortgage originators, get more loans from Google, AI search, and social media. We've got 3 different products that can help you do that. We've got Originator Success, Grab and Go Social, and Rate Sensei. Be sure to check those out. So here we are live. Remember, you can join me each and every weekday morning, 9:30 a.m. Eastern time. I broadcast on Facebook and YouTube talking about what's going on with the world of mortgages, especially what's going on with rates and pricing. Today, we're going to dive deep. We're going to talk about yesterday's Fed action and break it down. What happened, what it meant for rates yesterday, what it means for rates moving forward. We're also going to talk about the CME Fed Watch tool is broken. And I sent out yesterday's text alert based on that tool. And then after kind of reviewing things, because it just seemed so crazy, it's still broken. And I'm going to show you. But that's okay. We can get around that. And we're going to talk about whether to lock or float after the rate jump. And kind of go into more detail about why I would do what I would do and what I think matters. So that's what we got going on this morning. So if you're here this morning, say good morning. And I'm going to go ahead. Forgive me. I'm just making a quick update. It's being difficult here, but I will make it work. We will bend it to our will. Here we go. All right. And there it is. So, all right. So I got that up on the bottom. Anyway, if you like joining me live and you want a text reminder so you don't miss any of the action, you can get it signed up to get a text alert reminder at hmmr.io/reminder. It's absolutely free to you. We don't abuse our list. We don't sell your information. You can use this cool QR code over here if it's easier to sign up. If you're on your phone right now, take a screenshot. You can actually go ahead and use that QR code even on your screenshot. So there you go. All right. Well, let's get into the good stuff. Let's talk about what we got going on this morning. First, we're going to go ahead. Let's say hi to all the live folks here because I know some of you do watch on replay. And if you do watch, don't forget to give me a hashtag replay. But most people come live. So we got Deb Dickinson first to say hello this morning. Good morning, Deb. Chris Dickerson, great to see you. Leroy Romero, Mallory Fotiadis, Mike Brown, Kyle Mazikas, Brandy Brickler, Mike Tebow. Great to have you all here. Nicole Semerad, Rob Smith, Gary Foote, Michael Scott Love, Megan Bissell, Kelly Cargill, Vicky McSweeney. Good morning, all. If you're here this morning and I didn't say good morning, let me know. Ron Siegel, not on yet, so not telling us what wonderful day it is today. But if anybody knows, go ahead and Google it and throw something up there and we'll chat about that. But in the meantime, let's go ahead and let's get started and kind of go into what we wanted to go over. So first things first, yesterday, quick recap. Yesterday was a bad day for rates. And let me go ahead and I'll share my screen. We'll go into more detail about what we got going on and what it means for you here. So basically, if we take a look and let me make this larger and then we'll zoom in on it. All right, here we go. So let me just get this to go a little bit higher. All right, so taking a look here, yesterday was a bad day. And you could see that when pricing came out, we were right here, right around, where does that put us here? That puts us right around, let's see. So pricing came out, we ran around 101.40, right? So we were in this area right around 101.40. And we ended the day much, much worse than that, down around 101.10. We lost about minus 30 basis points on the day. That is a definite big deal. It's certainly enough to make you cry. Here, we'll put a little blue tears under his eyes here. It's certainly enough to make you cry. That's not what we want to see by any means. So yesterday was a bad day for rates, and you can see right here, 2 p.m. Eastern time. This is when the Fed came out with their policy statement, and you could see. I mean, if we just you want to go straight up here, and at 2 p.m. we really didn't see anything. It was flat, right? The policy statement itself was not a big deal. That's not what caused us heartache and pain. What caused us heartache and pain happened right here. And let's get rid of the Presentify for a minute so you can see what time it was. Right there at 2:34 p.m., you see mortgage-backed securities are at 101.32, right? So 101.32, and they drop all the way down to around 101.12. We lose minus 20 basis points right here. And what happened there? Powell's prepared comments. The damage didn't even wait until he actually started getting questions. He came out swinging. So yesterday, during the FOMC meeting, at the policy statement, the Fed released that they cut rates by a quarter point, and that brought us to 3.75 to 4.0. And by the way, I'm going to show you the issue that they fixed it this morning. They finally fixed it. I have screenshots though to show you that I'm not crazy. What happened was, there you go. I took a screenshot of it on my iPad and on my phone. They were showing the current target rate is 4. So what happened was they were showing to be to 3.75, which is where we actually were at 67%. So what they were off. And I only realized this after I had referenced them. And I've never seen them make a mistake like this before. So again, I'm sorry I'm jumping around a little, but talking about the FOMC, the FedWatch tool, and what that led us to believe. So anyway, let me kind of clear out. I'm sorry, we're jumping around a bit, and that just makes things utterly confusing. So let's go back to where we were, going back to mortgage-backed securities here. So Powell came out swinging, and he made a very clear comment here. He said a further reduction in the policy rate. Let me get this so that you guys can. Let me move this over so it fits on the screen. Hold on a minute. Okay. So Powell came out and he said a further reduction in the policy rate at the December meeting is not a foregone conclusion. And that was like the jab. And then he came in with the uppercut. And the uppercut is when he said far from it. And basically, this was Powell coming right off the bat during his press conference in the first few minutes. All right. Right in the prepared statement, he came out kind of setting the record straight for markets that although markets were pricing in almost 100% expectation of a Fed rate cut, look at this, 91% a week ago, 91% a week ago. That dropped all the way down to about 65%, 69% right now. So this drop right here is why you've seen rates move. Now, again, I have to fix what I put in the alerts yesterday. I put in the alerts yesterday that markets went from pricing in a 90% probability of a December cut to 0 chance of a cut, and instead a chance of a hike, because that's what they had here on the FedWatch tool. And again, I took a screenshot of it so that everybody would know that I wasn't just crazy. Hold on a second. I don't know why it's doing that. I don't want to edit. I just want to move this over. Bear with me. I'm just trying to get this to, sometimes getting these to adjust is such a pain in the neck. Here we go. All right. So this is what I was looking at yesterday when I put that out there. I wasn't totally like off the rails. Basically, this was the column, and they moved everything over. We went from here to here to nothing here, and it all shifted to here. That would have been really scary. I was like, whoa, this is huge. And that's not what happened. That is not the case. But again, yeah, that's, I didn't really catch that till later. They've corrected it now. They fixed the fact that they didn't adjust the quarter point cut, so everything was off by a column. So this is more realistic, and this is what we saw happen. So yesterday was a bad day for rates. The bigger component of why we saw that happen had to do with what Powell said at his press conference. Now, there's also some other things that we can kind of dive into here. Kind of summarizing where all of this goes. No, I don't want this part. I wanted where he's there. It is. So this is the Fed's balance sheet. I talked about how we could see some improvement if they're ending the balance sheet, but they said that they're going to continue to run off mortgage-backed securities. Hold on a minute. Excuse me. So Sean said he reverse jinxed everybody by locking. So, well, no. And that's why we floated into the meeting, because you need to keep your options open. What happens if they come in and they say, we haven't gotten data about the labor market. We're more concerned about the labor market. And without data to be data dependent, we're going to continue the course. We could have seen some improvement. But I've been saying for the last week that I didn't think there was a lot of room for improvement. And at the end of last week, I was locking loans closing near term and risk averse because I didn't think there was a lot of room for improvement. And I've said that over and over and over. However, I was being realistic of watching where mortgage-backed securities were going. And if we take a look here, mortgage-backed securities, we were looking for that 101.29 level to be the breaking point. And we broke above that 101.29 level. Again, Friday of last week, we were at 101.25. We stayed below that level. 101.31. I know it's technically above it, but 2 basis points, it's a rounding error. Like, it's not enough to really get convinced. But then, we started to see, okay, hey, this is continuing to improve. Maybe we've got some room. And the same thing with the 10-year Treasury yield. We saw it push up and test 4% again on Thursday, on Friday of last week. And then on Monday, it dipped back down. Tuesday, it dropped down even further. And that's what we were watching. And so it was like, okay, well, let's keep our options open and see. Even if we get improvement, like I said, it probably wouldn't be a lot of improvement, but it might have brought rates into that 5.99 mark where lenders are going to be more aggressive. So I'm going to put the lock advice up from here, and let's talk more about that, though. So basically, my lock advice is that loans closing near term and risk averse should strongly consider locking. And here's why. Look at the jump we've seen in this 10-year Treasury yield, 4.11 right now. If we round on that, it's 4.11. Okay. So we're up to 4.11. We were down at 3.98. That is a big jump. Why lock after that big jump? Well, first and foremost, I've said it before, I'll say it again. Yeah, everybody should be getting our text alerts. And I'm not throwing shade, but I will say that our alerts went out very quickly when things got ugly yesterday. And I think they were quicker than some competing services. I got this alert yesterday. The update was at 2:13. Hold on, I'm trying to get where you can bring it. There it is. And the alert came out at 2:40. Okay. So if you take a look here, oh, you can't see it. Let me pull this a little. All right. So see right there, that alert came out yesterday at 2:40 p.m. You'll see I can't pull it out and do this at the same time. But if you look over here, you can see that it was at 2:40. I don't want to reply to that. So you'll see at 2:40. So yesterday, we sent the initial one, not expecting a big reaction to the Fed statement, but the press conference, bonds show a stronger reaction, float to start, but be ready to lock if we get a negative reaction, right? Because we didn't know. You don't know what's going to happen at this thing. Then update after the meeting, initial reaction was not good, but not terrible. So we were kind of like waiting to see where things went, stay vigilant. And then boom, alert 10 minutes later. And normally we wait and see where things go during the question and answer period. Usually it's around 3:15 that we get a vibe, things kind of settle. But we saw that, remember, we saw it, that very, very strong reaction right here was an immediate reaction. This was an immediate reaction right here at about 2:35 as Powell came out with his prepared statements and said, that key sentence that we talked about over here, which was that his comments were that not only is further reduction in the policy rate is not a foregone conclusion, far from it. All right. So when he said far from it, that is like really like he's emphasizing, hey, stop betting on this. Now, I think we could see things get worse. If we look at what happened back with mortgage bonds after the last Fed meeting when things got worse, the last Fed meeting was on the 17th. The day before on the 16th, we were at 101.27. Then bonds dropped down to 101.03. That's down about 25 basis points for the initial reaction. Yesterday, we were down about 30 basis points. The next day, they were down. They started higher and ended the day lower. Then 101.05, 100.88, 100.91, all the way down to 100.77 2 days in a row. And this took about 2 weeks. This was a Wednesday. So this was Tuesday right here. So you got Wednesday, Thursday, Friday, Monday, Tuesday, Wednesday, Thursday, Friday. So about a week and a half, 10 days that we saw rates drop down. And when you look at what happened to actual rate sheets during that time frame, and again, let's turn off all these other things. We'll use Mortgage News Daily just as a reference point here. And we come back here, you can see, let me get this even a little bit tighter. Okay. We've dropped down 6.13 right here. That's not my circle. Here it is. 6.13 right there. And then they moved higher. And then 6.37, 6.39, 6.38, 6.37. And it just kind of stayed here. There really wasn't any reason. We didn't see things improve again until we saw a shift in Y. And that was over here at the beginning of October, and with the shutdown and not getting that labor market data, et cetera, everything kind of moving lower here and putting us in this position. Markets were expecting that we were going to see Fed rate cuts heading into 2026. That is starting to ease. So you can see right now about 70% expectation we'll get another cut in December. If we continue, that's going to be on the 10th. So we've got about 6 weeks. If this continues to move lower in that time, you're going to see mortgage rates creep higher and worsen. So it's just, there's not a lot of reason to expect things to improve from here. Julie floated until the day before. That's awesome. And again, floating into the meeting itself, Julie, though, as long as you lock before you get reprices, it's not bad to float into the meeting because you're keeping your options open. So, that's certainly not there. Mike Thibault pointed out, once again, things changed when Powell started talking. It really did. And I don't want to fault the guy because he's doing his job. He's signaling to the markets that the Fed is not looking to do 3 rate cuts. And when we looked at the Fed dot plot, when we look at the dot plot chart here, the expectation is to be at 3.75, right? To see that be in that range right there. So, that is 3.75 to 4 right there. So you could see that it wasn't real, or actually, I'm trying to see because I always do this above the line. So, but anyway, the bottom line is Fed, they're signaling that this is going to not happen. So, but with that note, I'm going to wrap it up. Ryan says, if the government shutdown ends, will that impact? Yes, because then we're going to start getting data again. Right now, November 7th is when we'd see the next big BLS jobs report. And if the market opens up, if the government opens back up, we will see some point where they start to talk about releasing data, but it might be delayed because they still have to gather the data, or they would still have to compile the data. Now, that's the other problem, is the arguments of these next reports that we get. There's nobody there gathering data right now. So how accurate would those reports be? So it definitely will play a role, and it depends on, just like always, what are markets' reactions to the data that we actually get, and what would that look like, and what would that be? Christy, I locked right before as well. I had a feeling. I always follow my hunch. Yeah, I mean, run with it and go with it if that's what works for you. But I'll emphasize, we were out there before a single, we were already out there before a single reprice came out. So, you can, as long as you have something to protect you, like our text alert service, we were sending out and said, hey, lenders may reprice worse first, bonds worsened, we may see recovery, because this was so quick after those statements. We saw the market already shifting down, and that was before lenders had a chance to reprice. So this is, as long as you're protecting your pipeline, and this is the best way to get the best of both worlds. So, but that's on there. But let's see, what else do you guys have to say? Just checking your comments, and then we'll wrap up. Another reason they want to keep the shutdown, they don't have to show the terrible jobs numbers. I don't really think so, because the Republicans are the ones that voted to pass the budget. It's the Democrats that are holding it back, and they're holding it back because I really feel they're saying it's because of the benefits and the subsidies for the Affordable Care Act, and all that. But it's really about optics. And they were, Schumer was totally picked on earlier in the year for, rolling over to Trump, and the progressive Democrats don't want the Democrats to, they want to push back on Trump more. And so we're seeing a lot more of that. I don't think it really, I don't think, as much as I know where you're coming from, one hand has nothing to do with the other. It's apples and oranges. Went to lock. Optimal Blue was down. Horrible timing. Really? The whole system? That's very frustrating. That's almost put on your aluminum foil hat kind of frustrating. Like, really, it was down at that critical time. Christy, I definitely pay attention to the text messages. I'll tell you that, super helpful. Well, they're helpful when they don't tell you something that's wrong like this. And again, just defending myself on why I put this on there. That was the data that it was showing. And it was like, whoa, this is a big deal. I've never seen CME FedWatch be wrong like that and not show, they were showing this right here. And I'm like, wow, we went from a month before, a week before, a day before, and now boom, like, that's huge. But that was corrected. It wasn't corrected until this morning, by the way. I submitted feedback that their information was wrong this morning. Maybe that's what did it. I don't know. But they did fix it this morning. So at least now we have accurate data. It went from about 85% down to about 65%. So this is what the expectation is for a rate cut. So Jerry, they had part of the system crash. That's brutal, man. That's very frustrating, because there's like, I don't know what to say to that. So, all right, my friends. Well, again, I am a Hammer, and check out some of our cool products. Go check out Grab and Go Social. I see a lot of you putting out posts about how the Fed rate cut and mortgage rates go up, but you don't do a good job of turning that into a sales post. We've got content to help you with all that. We've got coaching to help you with all that. You can get started at Grab and Go Social at $7. Grab and Go Social provides you with content daily. We have a whole entire content calendar every day where there's stuff for you to grab and go. So it's very quick and easy to post. These are high quality posts that help generate some activity. We've also, everything's customizable. So if you want to customize it a bit, you can go ahead and customize a lot of our content. We've got evergreen content to help you post on a regular basis. And then we've got coaching about how to really get more out of social, because that is where you can get a lot of your business today, is on social media, and everything plays together. That's why we've got our different suite of products, because everything plays together. Originator Success focuses on online branding, generating reviews, and staying in front of past clients, contacts, prospects with our, basically light CRM. Grab and Go Social is about you building your social presence and getting business on social platforms, TikTok, Instagram, Facebook, YouTube, really focuses on that. And then Rate Sensei is about using the rate market to generate business. I don't know if I saved it to my photos. Let me see if I have it here. And but like, yeah, here you go. So I'll show this up on the screen real quick. This is what Rocket put out there, and you may hate Rocket. I don't care. This is what they do right that others do wrong. Breaking news: the Fed rate drop. Take advantage of where mortgage rates are today. They don't talk about the Fed rate drop and what it did to mortgage rates and that it's this and all the different things. They just say now, and again, there's people doing a laughing face because those are mortgage people that know better. But consumers that see this, it generates business, y'all. It generates business. And somebody that's, you can explain more after you have the relationship, but this helps you to get them off the fence and have a conversation. And then you can talk more about it. The Fed did drop rates. As a matter of fact, that didn't lower mortgage rates. Mortgage rates actually crept higher because we've already priced in that September and that October cut. But markets are concerned now that we're losing a December cut. We were thinking we were going to get a December cut. Mortgage rates that were lower, we're anticipating that December rate cut. Now we're starting to doubt that cut and mortgage rates creeping higher. Better get in and do something before those rates get higher. And that's what you want to be having, that conversation like that. So anyway, that's the best advice I can give you guys for there. Megan said New Res was down for hours yesterday, and then you couldn't log in and emailed your aide. They wouldn't honor the timestamp saying you were trying to lock that. See, that's bullshit. That's bullshit. I'm with you though. I don't own the company, but we won't get into too much about New Res. Optimal Blue is having a cloud issue with Microsoft Azure and is affecting businesses globally. Yeah. It's crazy how you see how dependent we are on cloud services. AWS, Amazon Web Service, their cloud servers, Microsoft Azure cloud servers. So same kind of thing. But all right, my friends, I'm going to wrap it up. Y'all have a fantastic day. Tomorrow will be Friday. You know what that means. TGIF. And we'll have a better day tomorrow. In the meantime, keep your guard up. As it says at the bottom, I would be locking loans because I don't trust where we're going. Generally, after we've seen these Fed rate cuts, we've seen rates continue to worsen for at least a week to 10 days. And it doesn't have to be big losses, but it's continued losses. This morning, mortgage bonds, where are they? I'm looking right at the moment here to see where we're at. Hold on, what happened to my... There it is, FedWatch tool. Oh, let me get rid of this. Okay. Right now, mortgage-backed securities are down 5 basis points. Not brutal, but they could drift lower through the day. So just keep it out there. All right. Take care, everybody, and have a great one. Bye-bye.